If I only had $1,000 to invest today, I wouldn't invest it like a year ago. The reason is the current context. I'd structure it well from the start, not seeking quick doubles. We're in an environment with high rates, less liquidity, macroeconomic pricing, and huge tech infrastructure investment. This demands balance, not euphoria. So today, with $1,000, I'd seek three things: a macro-backed sector, a small structural potential position, and maintaining liquidity, as many experts suggest. Not to guess the bottom, but for margin. With that in mind, the $1,000 would be invested like this. Note, this is an educational example, not investment advice. 50% in an ETF like BOO, BTI, or CDCPX. It represents the full economy, avoiding reliance on a single narrative. 30% in an ETF tracking the energy sector like XLE. Why? The real economy still needs energy. Data centers increasingly consume electricity, and in high-rate environments, strong cash flow companies tend to resist better. 10% in a stock with structural potential, for example, Micron. Not due to trends, but because AI depends not just on chips, but advanced memory. Memory is a critical component for models to scale. This isn't the portfolio's core, it's a small position with a clear thesis. And 10% in liquidity or a high-yield account. Because today rates pay, and flexibility is power. Look, with little capital you don't need an instant home run. But you do need structure, broad exposure, a correct thesis, and room to maneuver. That's starting with a cool head. Remember, the error is using the same strategy in different contexts. Investing well isn't just picking assets, it's reading the moment. If you had $1,000 today, would you put it all in one stock or invest it like this? Subscribe to learn more.